This scramble to build AI infrastructure has really morphed into a credit race. AI just isn't really driving innovation, it's rewriting the playbook for how tech companies borrow, collateralize, and scale.
In the first half of 2025, something unprecedented happened. AI spending contributed as much to US GDP growth as consumer spending. For the first time in history, the economy's engine wasn't powered primarily by people, it was powered by machines.
This isn't just a quirky statistic. It's the beginning of a seismic shift. The consumer, once the king of the economy, is losing the throne. AI investment has exploded, rising 40 to 50 times in just 3 years, while consumer spending growth has slowed to its weakest pace in decades. Today, we'll uncover how this reversal is reshaping society, why your role as a buyer may no longer matter, and the shocking truth about who or what will drive the future economy.
So here's the challenge. Imagine a world where your paycheck, your shopping habits, even your desires no longer determine growth. Instead, trillion-dollar AI systems do. If your choices no longer fuel the economy, are you still a consumer or just a spectator?
For decades, one truth seemed unshakable. The consumer was king. 70% of US GDP still comes from household spending, a statistic repeated like scripture in every economics textbook. Politicians, advertisers, and CEOs all bowed to the same altar, your wallet. But here's the question. If consumers remain so dominant, why did AI spending suddenly match their contribution to growth in 2025?
This isn't a minor adjustment in the numbers. It's the first time in modern history that machines, not people, carried equal weight in driving the economy forward. The consumer's throne, once untouchable, is beginning to crack. And when thrones crack, they don't just wobble, they collapse.
The unsettling truth is that your role as an economic driver is shrinking. The system that once depended on your choices is learning to run without them.
Now, let's put hard numbers to that shift. In 2022, consumer spending added 2.6 percentage points to GDP growth. By 2025, that figure had collapsed to just 1.05. At the same time, AI surged from statistical noise, barely 0.02 points, to over 1 full point. That's not growth. That's a 40 to 50-fold explosion in only 3 years.
Think about the scale of that reversal. Households tightened belts, slowed purchases, and watched their influence fade. Meanwhile, corporations poured hundreds of billions into AI infrastructure, data centers, and chips. Investments so massive, they single-handedly kept GDP from slipping into contraction. Dual forces are at work. Human demand is slowing, machine investment is accelerating.
This is not balance, it's replacement. The consumer's decline and AI's rise are happening simultaneously, and the crossover point has already arrived.
Picture the economy stripped of its AI lifeline. Without the surge of machine investment in 2025, US GDP growth might have slipped below 1%, dangerously close to contraction. Imagine the headlines, "America on the brink of recession." But instead of collapse, the numbers held steady. Not because households spent more, but because corporations poured billions into servers, chips, and sprawling data centers. This is the new reality. Growth no longer depends on your shopping cart, your mortgage, or your weekend splurge. It depends on whether tech giants break ground on another hyperscale facility. The economy is being propped up by machines, not meals, by algorithms, not apparel. That's a game changer. When survival hinges on AI spending, the consumer's role shifts from essential to optional.
Consider the story of a mid-career worker in 2025.
Their paycheck buys less each month. Groceries up, rent up, credit card rates climbing. They cut back on dining out, cancel a streaming subscription, delay a vacation. Individually, these choices feel small. Collectively, they drag down consumer spending growth to its weakest pace in years. Now, contrast that with the boardrooms of the Magnificent Seven tech giants. While households trim budgets, these companies announce record AI investments, over $400 billion in a single year, a 60% jump from 2024. Their spending doesn't just offset consumer weakness, it overshadows it. The workers' restraint is drowned out by corporate excess. This is the divergence of our age, households tightening belts while corporations build empires of silicon. The economy grows, but not for you. If you want to stay human in an economy run by machines, resist being predictable. That may sound abstract, but think about it. Algorithms thrive on patterns. They anticipate your purchases, your clicks, even your moods. The more predictable you are, the easier it is for AI to reduce you to a line of code. In 2025, consumer spending slowed to its weakest growth in years, while AI investment surged 40-fold. That wasn't just a shift in numbers, it was a shift in leverage. The economy no longer waits for you to decide what you want. It predicts, prepackages, and delivers before you even think to ask. Your last real power is unpredictability. Break your patterns. Choose differently. Refuse to be reduced to a forecast. Walk through the husk of a suburban mall in 2025 and you'll see the ruins of consumer culture. Once these spaces were temples of spending, food courts buzzing, storefronts glowing, parking lots overflowing. Now many stand hollow, their echoes a reminder of a vanished era. Meanwhile, on the other side of town, a new kind of cathedral rises, the data center. In June 2025 alone, construction hit a $40 billion annualized rate, up 30% year over year. These massive, windowless fortresses don't sell sneakers or lattes, they sell processing power. They are built not for you, but for machines. The contrast is stark, malls collapsing into ghost shells, while data centers expand like monuments to a new faith. The economy is no longer building spaces for consumers. It's building infrastructure for algorithms.
Here's the paradox. AI spending is celebrated for its efficiency, yet that very efficiency erases individuality. Fact 1. AI investment now represents about 1.2% of US GDP, a share that barely existed 3 years ago. Fact 2. Consumer spending growth is projected to slow to just 1.4% in 2026, weighed down by tariffs and high interest rates. Machines accelerate, humans decelerate. On paper, this looks like progress, fewer inefficiencies, faster growth, cleaner supply chains. But beneath the surface, something vital is lost. Efficiency doesn't care about your quirks, your unpredictability, your messy human choices. It optimizes them away. The more efficient the system, the less room there is for individuality. That's the hidden cost of progress. Cheaper goods, but diminished freedom.
Jeff Hammerbacher, a former Facebook data scientist, once said, "The best minds of my generation are thinking about how to make people click ads." That was before AI. Now, those same minds are building systems that don't just make you click, they predict the click before you even think about it. In 2025, Goldman Sachs estimated AI had already added $160 billion to true GDP since 2022.
That's not advertising revenue. That's structural economic growth. The smartest engineers aren't designing for consumers anymore. They're designing for capital flows, for predictive models, for machine-to-machine economies. The quote that once sounded cynical now feels prophetic. The consumer isn't the target anymore. They're the training data.
Now, imagine a marketplace where the sellers aren't human, and neither are the buyers. We're already seeing the early signs. AI-generated influencers with millions of followers, avatars that never sleep, never age, never miss a trend. They sell products with perfect timing, flawless targeting, and zero overhead. But here's the twist. The audience they're selling to is increasingly AI-driven as well. Recommendation engines, predictive shopping carts, and anticipatory shipping systems are making purchases before you even click. This is commerce without consumers. Machines marketing to machines, with humans reduced to spectators in their own economy. The Magnificent Seven tech giants aren't just building infrastructure, they're building ecosystems where your role is optional. The future of demand may not be your desire, it may be an algorithm's forecast.
Now picture your paycheck disappearing, not because you lost your job, but because the job itself no longer exists. AI doesn't just replace workers, it replaces the need for their consumption. If machines generate the growth, why does the system need your spending power at all? This is the nightmare scenario economists whisper about, a post-consumer economy. Universal basic income debates are already circling this reality because if AI drives GDP while suppressing wages, households lose both their income and their influence. The economy grows, but the people inside it shrink. It's a chilling inversion, growth without prosperity, expansion without participation. The paycheck that once defined your role in society becomes irrelevant in a machine-driven order.
Money is no longer the only currency that matters. In 2025, retail sales totaled $4.2 trillion in the first half of the year, up just 3.6% year over year. Respectable, but sluggish compared to the machine economy. Now, compare that to AI investment in information processing equipment, which surged at a 39% annualized rate, 10 times faster. The real currency isn't dollars, it's data. Every click, every scroll, every pause on a video is logged, analyzed, and monetized. Your attention has become the new dollar, your behavior the new commodity. And unlike cash, you can't stop spending it. Even when you're idle, your data is working for someone else.
This is the quiet revolution. Consumption is shifting from goods to attention. The economy no longer needs you to buy, it just needs you to look.
Take the story of a teenager in 2025. Their TikTok feed doesn't just entertain them, it shapes their worldview. Algorithms decide what they laugh at, what they believe, even what they aspire to become. School may teach math and history, but TikTok teaches identity. This isn't trivial. When consumer spending slows, platforms double down on engagement. They don't just want your purchases, they want your time, your emotions, your sense of self. For many young people, the feed is more influential than family or teachers. It's where they discover music, politics, fashion, even morality. The consumer has become the consumed. Instead of shaping markets with their choices, individuals are shaped by the markets of attention.
What happens when AI knows your desires before you do? This isn't science fiction, it's already here. Predictive algorithms track your browsing, your purchases, even the pauses in your scrolling. They don't just respond to your choices, they anticipate them.
In 2025, Amazon filed patents for anticipatory shipping, where products are boxed and shipped before you'd even clicked buy. Think about the implications. If the system already knows what you'll want, your freedom to choose becomes an illusion. You're not deciding, you're confirming. The consumer's role shifts from active participant to passive validator of machine predictions. This is predictive policing of consumption. And once your desires are forecasted, they can also be manipulated.
Historian Yuval Noah Harari once warned, "Once we can hack humans, we no longer need democracy." That line wasn't about politics alone. It was about consumption, too. If algorithms can hack your attention, your cravings, your impulses, then they don't need your conscious participation. In 2025, AI investment surged past $400 billion, while consumer spending growth slowed to a crawl. The balance of power is shifting from voters and buyers to coders and servers. Harari's warning echoes louder now. Once humans are predictable, they're controllable. And once they're controllable, they're dispensable. The consumer's fall isn't just economic, it's existential.
Here's the tension point. Fact 1. Consumer spending still accounts for roughly 70% of US GDP. On the surface, that dominance looks unshakable. Fact 2. Its growth rate has slowed to just over 1%, while AI investment has exploded 40 to 50-fold in 3 years. Machines are accelerating, humans are decelerating. This is the illusion of stability. Yes, consumers remain the largest slice of the pie, but the momentum is elsewhere. Economies don't reward size, they reward growth. And right now, growth belongs to AI. That's why Goldman Sachs warns that without AI spending, GDP might already be in contraction. Cheaper goods, faster services, sleeker systems. Yet the hidden cost is agency.
One of the biggest mistakes we make is assuming regulation will keep pace with AI. History says otherwise. In 2025, while AI spending surged past $400 billion, lawmakers were still debating frameworks written for the internet age. By the time rules are drafted, the technology has already leapt ahead. Consumers cling to the idea that governments will protect their role in the economy. But the truth is harsher. Regulation lags, innovation races. Tariffs and interest rates may slow household spending, but nothing slows the capital pouring into data centers and chips. The imbalance grows wider with every quarter. Waiting for regulators to defend consumer power is like waiting for a referee who never shows up.
Here's the cruel irony. The consumer doesn't just fall, they're recycled into the raw material of the new economy. Your spending may slow, but your data never stops flowing. Every search, every swipe, every GPS ping becomes fuel for the very AI systems that are replacing your role. Think about it. You're no longer the buyer. You're the commodity. Your preferences are harvested, packaged, and sold to train models that anticipate demand without you. The economy doesn't need your wallet if it already has your behavior. This is the inversion of consumerism. You thought you were the customer, but you've always been the product. Now, in the age of AI, that truth is no longer hidden. It's the business model.
By 2027, AI capital expenditures are projected to exceed $500 billion, more than the annual GDP of Singapore. At the same time, consumer spending growth is forecast to slow even further, dragged down by tariffs and high interest rates. The trajectory is clear. AI is becoming the primary driver of growth, while consumers fade into the background. This is the dawn of a post-consumer society.
an economy where machines trade with machines, where growth is measured not by what households buy, but by how much processing power is deployed. In this world, human demand is optional. That's the future we're hurtling toward, an economy that grows without us.
The consumer's fall isn't just about shopping habits or retail sales. It's about power. For over a century, your choices defined the rhythm of the economy. But in 2025, that rhythm changed. AI spending surged 40-fold, data centers rose like cathedrals, and machine investment matched the contribution of every household combined. The message is clear. The economy no longer waits for you.